I am going to tell you something that will sound arrogant, but I have earned the right to say it, and you need to hear it before the window closes. Most people watching this video will be too late. Not because they are unintelligent, not because they are lazy, because they are waiting for permission. They are waiting for the mainstream to confirm what is already visible to anyone paying attention. And by the time the mainstream confirms it, the people who acted early will already be on the other side of the largest wealth transfer in the history of technology. I'm Jensen Huang. I co-founded NVIDIA in 1993 in a Denny's booth with $40,000 and an idea that most people in Silicon Valley told me was wrong. I built it into a company worth over $3 trillion. I have spent 30 years building the infrastructure that the entire AI revolution now runs on. Every major AI model in the world, GPT, Gemini, Grok, every one of them was trained on NVIDIA hardware. I did not predict the AI revolution by accident. I saw the machine that was being built underneath the surface years before anyone was writing headlines about it. I made bets that looked insane at the time and turned out to be the most important bets in the history of the technology industry. And right now, I am watching the exact same pattern repeat, except this time, the machine is not being built for one company or one industry. It is being built for every company, every industry, every country on Earth simultaneously. The window to position yourself on the right side of this transition is not 10 years. It is not 5 years. Based on the infrastructure deployment cycles I have watched my entire career, the window for the returns that will make people generationally wealthy from the AI transition is approximately 11 months. After that, the assets that are still reasonably priced today will have already re-rated. The easy returns will be captured. And the person watching a video like this in 2027 will be listening to stories about what was obvious in 2026, wondering why they did not act. I am not here to sell you anything. I am here to show you what I see from where I sit, at the center of the most important technological transition in human history, and give you the framework to decide what to do about it. Hit subscribe right now, because the second half of this video covers the exact infrastructure layer that smart money is moving into, and the specific instruments available through any standard brokerage account. Stay until the end, because the third category I am going to show you is the one almost nobody is talking about, and historically it is the one that produces the largest returns in the earliest stage of a platform transition. Let me start with a story, because the data will not change your behavior. A story might. In 1999, I met a man named Thomas at a conference in San Jose. He was 44 years old, a senior engineer at a mid-sized software company, smart, experienced, deeply knowledgeable about technology. He had watched the dot-com boom from the inside and was deeply skeptical of the hype. He told me that night that the internet was overvalued, that the fundamentals did not support the prices, that most of these companies would fail. And he was right. The dot-com crash came in 2000. He felt vindicated. His conservative portfolio held up better than his colleagues who had bought Pets.com and Webvan. But here is what Thomas missed. When he concluded that the dot-com bubble was a fraud, he drew the wrong lesson. He concluded that transformative technology was always overvalued, that the hype always outran the reality, that the skeptic was always right. So in 2004, when a company called Google went public, Thomas did not buy. He said the search engine market was too competitive and the price was too high. Google went from $85 per share at IPO to over $3,000 before the split. In 2007, when Apple released the first iPhone, Thomas said smartphones were a niche product for early adopters. Apple's stock returned over 6,000% in the decade that followed. In 2012, when NVIDIA was still primarily a gaming chip company and I began shifting our entire research focus toward parallel computing and what I believed would become artificial intelligence infrastructure, Thomas looked at NVIDIA's price to earnings ratio and said it was expensive for a graphics card company. NVIDIA's stock has returned over 30,000% since then. Thomas retired last year. He is comfortable. He is not poor, but he is also not the person he could have been. He made the most common mistake that intelligent, experienced, skeptical people make when a genuine platform transition arrives. He waited for certainty, and certainty never arrived early enough to matter. I saw Thomas at an event in Seattle 6 months ago. He told me he was finally buying AI stocks. He had read about the ChatGPT explosion. He had watched the coverage. He felt the evidence was now conclusive. He was buying at valuations that priced in 5 years of growth already. He was entering exactly where early investors were beginning to take profits. The window had not closed entirely, but it had compressed dramatically. Do not be Thomas. Now, let me explain the machine. Because once you understand the mechanics of a platform transition, you will never misread one again. Every 20 to 30 years in the history of technology, something fundamental changes, not incrementally, structurally. A new foundational layer appears that makes everything built on top of it radically more capable, radically more efficient, and radically more economically valuable. The mainframe computer was the first layer. It centralized computation for large institutions. The personal computer was the second. It decentralized computation to individuals. The internet was the third. It connected those individuals and their computers into a single network. The smartphone and cloud were the fourth. They made that network accessible from anywhere all the time. Each of those transitions produced a generation of companies worth trillions. Each of them also produced a generation of investors who were too early, a generation who got the timing right, and a generation who arrived after the compounding had already happened. The fifth transition is artificial intelligence, not AI as a feature. AI as the foundational layer itself, the new operating system on top of which everything else will be rebuilt. And here is the critical thing that most investors are getting wrong right now. They are treating AI like a software trend. They are buying the companies building the AI applications, the chatbots, the assistants, the co-pilots. Those companies may do well, but they are not the infrastructure layer. They are the applications built on top of the infrastructure layer. In the early internet era, the companies that made the most durable generational wealth were not the dot-com application companies, most of which failed. They were the infrastructure companies, the companies that built the fiber optic cables, the companies that built the routers and switches, the companies that owned the data centers, the companies that made the chips that powered the servers. The AI era is following the exact same pattern. The infrastructure underneath will capture the largest and most durable economic value. And right now, that infrastructure layer is still in the early deployment phase. Let me explain what I mean by that precisely. The global AI infrastructure build-out is currently consuming capital at a rate that most people do not understand. Microsoft, Google, Amazon, and Meta collectively announced AI capital expenditure plans exceeding $300 billion for 2025 and 2026 combined. That is not product development spending. That is infrastructure. Servers, networking, power, cooling, land. Every dollar of that $300 billion has to flow through a specific set of choke points. The companies that make the hardware, the software, and the physical infrastructure that AI requires to run. These choke points are not evenly distributed. They are concentrated in a small number of companies that have years of competitive moat built around them and cannot be easily replicated by a new entrant. I have spent 30 years building one of those moats. And I can tell you from direct experience, the lead time to build what we have built at NVIDIA is not 1 year or 2 years. It is a decade of continuous investment in hardware architecture, software frameworks, developer relationships, and manufacturing partnerships. Anyone who tells you that a new competitor is 12 months away from displacing the infrastructure layer of the AI transition does not understand how this industry works. That moat is what creates durable returns. And the window to enter the infrastructure layer at prices that have not yet fully priced in the next 3 to 5 years of deployment is approximately 11 months. After that, the institutional capital that is currently still in the research and evaluation phase will have completed its allocation. The price action that follows institutional allocation at scale is different from what exists today. Let me show you where I see the specific value. Before I do, I want to be clear about something. Everything I am about to share is my personal analytical framework based on my 30 years of direct experience in the technology industry. This is not investment advice. What you do with your own money is your decision, and ideally you make it with people who know your specific situation. What I can give you is the strategic framework that I believe the historical pattern points to. The first category is AI-accelerated computing infrastructure. This is the foundation, the hardware layer that every AI model, every AI application, and every AI service in the world runs on. You cannot train a large language model without it. You cannot run inference at scale without it. You cannot build the AI-powered products that companies are racing to deploy without it. The dominant company in this space is NVIDIA, ticker NVDA. I want to be transparent. I am the CEO of NVIDIA, and I own significant amounts of NVIDIA stock. But my transparency here is exactly the point. When the CEO of the company building the foundation of the AI revolution is personally invested in that company's long-term trajectory, you should understand why. For investors who want broader exposure to the AI semiconductor space without single company concentration, the VanEck Semiconductor ETF, ticker SMH, holds NVIDIA alongside TSMC, ASML, Broadcom, and the other critical hardware companies in the AI supply chain. TSMC, ticker TSM, is the most important company most people have never heard. They manufacture essentially every advanced semiconductor in the world, including NVIDIA's GPUs. There is no AI without TSMC, and there is no company that can simply replicate what TSMC does. The manufacturing process technology they have built represents 40 years of continuous investment. Their competitive moat is among the deepest in the history of industry. Broadcom, ticker AVGO, builds the custom AI chips and networking infrastructure that the hyperscalers, Google, Amazon, Meta, use to build their own AI systems alongside NVIDIA hardware. They are the second choke point in the AI hardware stack. Allocate 35 to 40% of your AI infrastructure positioning here. This is the bedrock. Everything built on top of it depends on it working. The second category is AI power and physical infrastructure. This is the one that most people are missing entirely. And it is the one that I believe will produce some of the most surprising returns over the next 3 to 5 years. Here is the fact that changes everything. AI is not just a software revolution. It is a physical infrastructure revolution. And the physical constraint that nobody is talking about loudly enough is power. Training a single large AI model consumes as much electricity as a small city uses in a month. Running inference, answering questions, generating images, processing requests at the scale that the major AI companies are planning requires power consumption on a scale that the existing US electrical grid was not designed to handle. The hyperscalers know this. Microsoft, Google, and Amazon are signing 20-year power purchase agreements at a pace that the energy industry has never seen before. They are funding the construction of new power plants, including nuclear plants, specifically to power their AI data centers. They are competing for every available megawatt of power in every major market. The companies that own electricity generation, transmission, and distribution in the markets where AI data centers are being built are not being priced as AI companies. They are still being priced as boring regulated utilities. But their revenue trajectory over the next 5 years looks nothing like the utility business of the last 20 years. Vistra Energy, ticker VST, is the largest independent power producer in the United States. In 2024, their stock was up over 260%. Most people had never heard of them. They are not a technology company. They generate electricity, including from nuclear plants in the markets where AI data centers are concentrating. Constellation Energy, ticker CEG, operates the largest fleet of nuclear power plants in the United States. They recently signed a 20-year power purchase agreement with Microsoft specifically to supply electricity to AI data centers. This deal changed how the market understands their business model, and the re-rating has still not fully reflected where their revenue trajectory is heading. For broader exposure, the iShares Global Clean Energy ETF, ticker ICLN, or the Utilities Select Sector SPDR, ticker XLU, provide diversified exposure to the power infrastructure that AI requires. But understand, within those broad funds, the specific companies signing AI data center agreements are the ones with the most differentiated earnings trajectory. Allocate 20 to 25% here. This is the category that will surprise people in 18 months when the earnings reports begin reflecting the AI power contracts already. The third category is the one almost nobody is discussing: AI enabling real estate. Specifically, the companies that own the land, the buildings, and the physical facilities where AI computation happens. Data center REITs, real estate investment trusts that own and operate the facilities housing the servers that run AI, are the landlords of the AI revolution. And right now, The demand for data center space is expanding at a pace the supply cannot keep up with. Equinix, ticker EQIX, is the largest data center REIT in the world. They own over 260 data centers across 70 metropolitan areas globally. Every major AI company is their tenant. When AI demand expands, Equinix's occupancy rates and rental pricing power expand with it. Digital Realty, ticker DLR, is the second largest. They have been signing AI-related leases at rates that are 40 to 60% higher than their existing average lease rates. As older leases roll over at new market rates, their revenue per square foot will increase dramatically over the next 3 to 5 years. Iron Mountain, ticker IRM, has pivoted aggressively from physical document storage to data center operations. They are currently the most undervalued company in the data center infrastructure space because the market still thinks of them as a filing cabinet business. Their data center capacity is growing 25% annually. Their stock is still priced as a slow-growth legacy business. For broad exposure, the Pacer Benchmark Data and Infrastructure REIT ETF, ticker SRVR, holds the data center REITs as a group. These are not tech stocks. They pay dividends. They have physical assets backing them. And they benefit from every dollar of AI infrastructure spending, regardless of which AI company wins the software competition. Equinix does not care whether OpenAI or Google wins the AI model war. They are the landlord for both. Allocate 15 to 20% here. This is the infrastructure under the infrastructure. And it is still priced as boring real estate in an environment where the space it provides has become the most strategically valuable square footage on Earth. The fourth category is the optionality layer. This is where the highest risk and the highest potential return intersect. It is where you allocate the capital you can afford to have move against you for 12 to 24 months while the broader thesis develops. AI application companies that have crossed the threshold from experiment to essential business tool. Companies that have demonstrated real revenue from AI, not just AI features bolted onto legacy products. ServiceNow, ticker NOU, has integrated AI into enterprise workflow automation. Their revenue growth accelerated after AI product launches. They are the clearest example of an AI application company whose product is genuinely replacing human labor at scale in enterprise environments. Palantir, ticker PLTR, builds AI data analysis platforms for government and enterprise customers. Their government contracts are now expanding into AI-specific use cases with multi-year revenue visibility. They are expensive on conventional metrics, but conventional metrics were not designed to price companies that are compounding revenue at 30% annually with a government-protected moat. These are the volatile part of the AI infrastructure portfolio. They can fall 40% and then double. They require a time horizon of at least 2 to 3 years and the emotional constitution to not panic during the inevitable corrections. Allocate no more than 10 to 15% here. This is the satellite position around a core of more durable infrastructure assets. Now let me show you what the total portfolio structure. 35 to 40% in AI accelerated computing hardware. NVIDIA, SMH, TSMC, AVGO. 20 to 25% in AI power and physical infrastructure. VST, CEG, XLU, ICLN. 15 to 20% in AI enabling real estate. EQIX, DLR, IRM, SRVR. 10 to 15% in AI application optionality. Now, PLTR. The remainder in your existing diversified base. The logic of this structure is simple. The first 3 categories benefit from AI infrastructure deployment, regardless of which AI companies win the application layer competition. They are picks and shovels in a gold rush. You do not need to predict which miners find gold. You need to own the hardware stores. The fourth category is your bet on specific application winners. It is smaller because it is less certain, but it is present because the upside in the early winners of a platform transition is historically enormous. Let me tell you how to implement this without making the mistakes that cost most people the returns they came here looking for. Week 1, open your brokerage account. Look at your current technology allocation. What do you actually own? Index funds? Which ones? At what concentration? Most people who think they have technology exposure are primarily holding mega cap consumer internet companies at valuations that already price in years of growth. That is not AI infrastructure positioning. That is backward-looking concentration. Calculate what 5% of your investable assets looks like in dollars. That is your first allocation target. Start with SMH for broad AI hardware exposure before you add individual names. Month 1. Buy your first AI infrastructure position. SMH for the hardware layer, EKX for the data center real estate layer. These two positions alone give you exposure to both the computation and the physical infrastructure of the AI transition. Research Vistra and Constellation. Understand their power purchase agreements. Understand why electricity is the constraint nobody is talking about loud. Set a price target for your first power infrastructure position. Month 2, add your power infrastructure position, VST or CEG or both. Add a second data center position, DLR for diversification within the real estate layer. Review your existing index fund holdings. Identify the overlap. If you hold QQQ or SPY at significant size, understand that you already have NVIDIA exposure, but at a weight determined by index committee decisions, not by your own analysis of where value concentrates. Month 3, begin building your application layer optionality position if you have the risk tolerance and the time horizon. Research ServiceNow's enterprise AI product revenue trajectory. Understand Palantir's government contract pipeline. Decide on sizing. By month 4, you should be at your target allocation. Rebalance quarterly. The discipline of quarterly rebalancing forces you to sell what has outperformed and add to what has lagged, systematically and without emotion. It is the mechanism that prevents you from holding concentrated gains too long and missing the rebalancing. Here is what happens next. The 11-month window I described is not arbitrary. It is based on the deployment cycle of AI infrastructure that is currently underway. The $300 billion in AI capital expenditure announced for 2025 and 2026 will show up in the revenue and earnings of AI infrastructure companies beginning in the second and third quarter of 2026 and accelerating through 2027. When those earnings reports arrive, when the market sees the revenue trajectory of companies like Equinix and Vistra and Digital Realty beginning to reflect AI-specific demand, the re-rating happens. The re-rating is when the market revises its expectation of what these companies are worth permanently and rapidly. The investors already positioned capture that re-rating. The investors who read about it after the fact buy into the new higher price. That is the window between now and when the re-rating begins. I have watched this pattern every time a new platform transition arrived in my career. The internet, the cloud, mobile. Each time there was a window, usually 12 to 18 months, between when the infrastructure investment became visible and when the earnings impact became undeniable. The people who positioned during that window made fortunes. The people who waited for the earnings reports bought at the post-re-rating price. We are inside that window right now. I came to the United States at 10 years old from Taiwan. I did not speak English. My parents sent me to live with an uncle so I could attend American schools. I worked as a busboy at Denny's during high school. I put myself through Oregon State and Stanford. I have spent my entire adult life betting on things that looked impossible and building them until they became inevitable. The AI transition is not a bet anymore. It is already happening. The revenues are real. The capital expenditure is real. The competitive dynamics are real. The only question that remains is whether you will be positioned to participate in the next phase of value creation, or whether you will be Thomas watching it happen from the outside, waiting for certainty that never arrives at a price that makes sense. The window is open. The infrastructure is being built. The earnings are coming. Most people watching this video will understand the logic and do nothing. They will close the tab feeling informed and continue holding exactly what they held before. The people who act in the next 72 hours will have a story to tell in 3 years. Decide which story